This is game-changing. Silver stackers, don't miss this. Gold price news update 2. Right now, if you are holding physical silver, if you have been stacking those rounds, those bars, those constitutional coins, or if you are simply watching the precious metals market from the sidelines, wondering if you missed the boat or if you should jump in head first, you need to understand something critical. The game is shifting beneath our feet, and most people are going to realize it only after the opportunity has widened into a chasm that they can no longer cross. We are living through a period of monetary history that textbooks will dedicate entire chapters to. And the average person is scrolling past it, distracted by the noise of daily politics, celebrity gossip, and the latest gadget release. But you are here because you sense it. You feel it in your gut when you look at your bank statement, when you fill up your gas tank, when you walk through the grocery store and see the same items costing double what they did just a few years ago. Something is off. Something is fundamentally breaking in the financial matrix, and the assets that have preserved wealth for 5,000 years, gold and silver, are starting to wake up from a decade-long slumber. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Today is Tuesday, 24th of February 2025, New York time. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Use Day. Now, let's talk about why this moment is so uniquely positioned to be, as the title says, an absolute game changer for silver stackers specifically, and why the gold price news update that is circulating right now should be viewed not as a random fluctuation, but as a signal flare illuminating the path forward. You see, for years, the narrative around silver has been one of frustration. It has been labeled the poor man's gold, the volatile cousin, the industrial metal with a monetary twist that just couldn't seem to catch a bid. Stackers have sat on massive paper losses, watching their holdings go nowhere, while inflation ate away at the purchasing power of the dollar. They watched as tech stocks skyrocketed, as cryptocurrencies went parabolic, as real estate doubled and tripled in value. They held their silver, and they held their gold, and they were mocked for it. They were told they were living in the past, that digital assets were the future, that hard assets were for doomsday preppers and conspiracy theorists. But here is the thing about the truth. It doesn't care about your opinion of it. It waits, it sits patiently, and eventually, reality comes knocking. And right now, reality is kicking the door down. The macroeconomic backdrop has shifted so violently that even mainstream financial outlets, the same ones that ignored silver for a decade, are starting to ask questions. Sovereign debt is spiraling out of control. The United States national debt clock ticks forward with the relentlessness of a metronome, adding trillions in the span of months, not years. The cost of servicing that debt is now the fastest growing line item in the federal budget. What happens when the largest economy in the world has to roll over its debt at interest rates that are multiples of what they were just a few years ago? You get a mathematical impossibility. You get a situation where the only viable path forward is to devalue the currency, to inflate away the debt, to print money and hope the rest of the world continues to accept it. But here is the suspenseful part, the part that should make you lean forward in your chair. The rest of the world is watching. They are watching, and they are acting. Central banks across the globe, particularly in emerging markets, have been buying gold at a pace not seen since the collapse of the Bretton Woods system. They are diversifying away from the dollar. They are bringing their gold home from vaults in London and New York. They are signaling, in the quiet language of central banking, that trust in the fiat system is eroding. And when central banks lose trust, they don't sell stocks or bonds. They buy gold. They buy the one thing that has no counterparty risk. And where gold goes, silver follows, but often with more volatility and, crucially, more potential upside. Consider the industrial thesis for silver for a moment, because this is where the game-changing label becomes truly undeniable. We are in the midst of an energy transition that requires massive amounts of physical materials. Solar panels, electric vehicles, 5G infrastructure, military technology, medical devices. They all require silver. Silver is not just a monetary metal. It is the best conductor of electricity on the planet. It is the most reflective metal. It has antibacterial properties. It is foundational to the modern world. And yet, we are facing a supply deficit that has persisted for years. We are mining less silver than we are consuming, and that deficit has to be made up from somewhere. Historically, that somewhere was scrap recycling and existing above-ground stocks, but above-ground stocks of investment-grade silver are dwindling. The COMEX warehouses, which hold the paper contracts that supposedly back the futures market, have seen inventories drawn down significantly. The LBMA vaults in London are seeing similar trends. There is a physical squeeze building, and it is happening quietly beneath the surface, while most traders are focused on the daily fluctuations of the Nasdaq or the latest Federal Reserve commentary. This is the setup. This is the powder keg. All it needs is a spark. And that spark could come from anywhere. It could come from a sudden shift in investor sentiment. It could come from a crack in the paper market, a delivery default that exposes the fiction that there is unlimited silver available at a price just a few dollars higher. It could come from a geopolitical event that disrupts mining supply. The point is, the conditions are ripe. The asymmetry is in your favor if you are a holder of physical metal. The downside, in real terms, is limited because the dollar is losing purchasing power every single day. The upside, in real terms, is massive because the repricing that needs to happen is not a 10% or 20% move. It is a multi-100% move to bring the price of silver back in line with its historical ratio to gold and to account for the massive monetary expansion we have seen. Now, let's talk about the psychology of being a stacker in this environment, because the mental game is often harder than the financial game. When you hold physical silver, you are holding something that the financial system does not want you to hold. The banking system profits from velocity, from loans, from credit creation, from transaction fees. Physical silver just sits there. It doesn't pay interest. It doesn't generate a yield. It doesn't show up on your brokerage statement as a line item that your advisor can manage for a fee. It is outside the system. It is a rebellion in your pocket. And because it is outside the system tries to make you feel stupid for holding it. It tries to convince you that you should be more productive with your capital, that you should be earning a return, that you should be leveraging up. This is the propaganda of the debt-based fiat system. But what happens when the system itself becomes unstable? What happens when the counterparties you trusted, the banks you deposited with, the brokerage firms you traded through, become distressed? What happens when there is a bank holiday or a bail-in, like we saw in Cyprus in 2013? In those moments, the guy with physical silver in his safe, in his sock drawer, in his hidden floorboard, is not panicking. He is not worried about a computer glitch locking him out of his account. He is not concerned about a government decree freezing his assets. He has possession. He has control. And in a crisis, possession and control are worth more than any yield. That is the ultimate insurance policy that silver provides. It is not just an investment, it is a shield. And right now, with global tensions escalating, with the specter of war in Europe and instability in the Middle East, with the breakdown of trust between the world's largest economies, that shield is more valuable than the spot price reflects. So, as we move into the core of this discussion, I want you to feel the weight of this moment. I want you to understand that the news headlines about gold hitting new highs, about silver lagging behind, about the Fed pausing or cutting rates, all of that is just surface noise. What matters is the deep current. What matters is the tide that is turning. And if you are a silver stacker, if you have been patiently accumulating, do not let the frustration of the last few years shake you out now. Do not let the desire for quick profits in meme stocks or AI hype trains distract you from the foundational asset that you are building. You are not just buying metal, you are buying your freedom. You are buying optionality. You are buying the ability to opt out of a system that is designed to extract your time and energy and leave you with nothing but digits on a screen. The game is changing. The rules are being rewritten. And those who hold the real assets, the ones that cannot be printed, the ones that have intrinsic value, will be the ones standing when the dust settles. Now, let's go deeper into exactly why this gold price action is the canary in the coal mine, and what it means for your silver stack going forward, because the connection between the two is tighter than most people realize. And the divergence we are seeing right now is creating the opportunity of a decade. Let's go deeper into the machinery of this market, because understanding how the price of gold and silver is actually discovered, or more accurately, suppressed and then suddenly unleashed, is the difference between being a confident holder and being a nervous wreck who sells at the first sign of a pullback. The gold price news that you are seeing flash across your screens right now, the new all-time highs, the volatile swings, the headlines screaming about profit-taking or resistance levels, is not just random chaos. It is the visible manifestation of a war that is being fought in the shadows of the financial system. It is a war between physical demand and paper derivatives, between Eastern accumulation and Western financial engineering, between those who want to suppress the price to maintain the illusion of dollar stability and those who are quietly, relentlessly accumulating the real metal because they see the cliff that lies ahead. And in this war, silver is the highly explosive, undervalued asset that could detonate at any moment. You see, for decades, the price of silver has been managed. It has been capped. It has been held down by massive short positions on the COMEX, primarily by a handful of large commercial banks, who use paper contracts to flood the market with supply that doesn't physically exist. They sell silver they don't have, they promise delivery they can't make, and they do it with the implicit blessing of the regulatory bodies that are supposed to oversee these markets. It is the largest manipulation in the history of finance, and it has persisted because it serves the interests of the powerful. A rising silver price is a vote of no confidence in the central banking system. A rising silver price is the free market screaming that the currency is losing value, so they suppress it. They clamp down on it. They use every tool in the algorithmic trading arsenal to keep it contained. But here is the thing about suppression. The pressure builds. It builds and it builds and it builds, and eventually it has nowhere to go but up. Now, imagine for a moment that you are one of these commercial banks. You have been short silver for years. You have been selling contracts to deliver physical metal at a future date, collecting premiums, and using your massive balance sheet and high-frequency trading algorithms to keep the price from running away from you. It has been a profitable trade. It has worked. But then, something shifts. The central banks of China, of India, of Russia, of Turkey, they start buying, not paper, but physical. They take delivery. They load up cargo planes and ships. They empty the vaults in London. They take the metal out of the system entirely. And at the same time, retail investors around the world, millions of them, are doing the same thing. They are buying coins, buying bars, buying rounds, and they are taking delivery. They are putting it in safes, in deposit boxes, in hidden compartments. The metal disappears from the accessible market. The above-ground supply that is available to settle those COMEX futures contracts shrinks. The commercials who are short start to get nervous. They start to realize that if the price runs, if the physical buyers step in and demand delivery, they might not be able to source the metal. They might be forced to cover their short positions at much higher prices. This is the dynamic that creates a short squeeze. This is the dynamic that took silver from $18 to nearly $50 back in 1980, and from $15 to $48 in 2011. It is the same setup, the same ingredients. And right now, the ingredients are more potent than they have ever been. The monetary base has expanded more in the last 5 years than in the previous 50. The supply deficits are larger. The geopolitical tensions are higher. The distrust in institutions is greater. The conditions are perfect for a historic move. And yet, the price action remains muted compared to what the fundamentals suggest. That divergence, that gap between reality and price, is the opportunity. Let me add a layer of suspense here that should make you sit up and pay attention. There is a concept in market analysis called the maximum financial pain point. It is the price level at which the most number of traders, the most leveraged positions, get wiped out. The system is designed in many ways to hunt for this pain point. It shakes out the weak hands before it allows a trend to truly begin. And right now, the positioning in the silver market is telling a story. The managed money traders, the hedge funds, the speculators, they are not heavily long silver. In fact, they have been net sellers. They have been convinced by the suppression that silver is a dog, that it will never break out, that it is a waste of capital. They have positioned themselves for lower prices. The commercial banks, on the other hand, are massively net short. They are betting against the price. This is the classic setup for a short squeeze. The commercials are on one side, the specs are on the other, and the physical market is tightening in a way that neither of them fully appreciates. When the physical buyers decide they want their metal, when the holders of those COMEX futures contracts say deliver instead of roll, the commercials will have to scramble. They will have to buy back their short positions in the open market, driving the price higher. And as the price rises, The specs who were short will get margin calls, forcing them to cover, driving the price even higher. And the specs who were long, who sold out too early, will FOMO back in, driving it higher still. This is how price explosions happen. This is how silver goes parabolic. And the trigger for all of this could be something as simple as a headline, a tweet, a breakdown in the repo market, a bank failure, a currency devaluation. It could happen next week, next month, or next year. Timing is impossible to predict. But the setup, the structural setup, is undeniable. Now let's bring gold into this discussion more directly, because gold is the general and silver is the soldier. Gold leads, silver follows, but when silver follows, it often does so with a vengeance. Look at the gold price action over the last 18 months. It has been quietly, steadily climbing. It has broken through resistance levels that held for years. It has established a new floor above $2,000 an ounce. It has done this despite a strong dollar, despite high interest rates, despite all the headwinds that conventional financial theory says should be bearish for gold. Why? Because the market is looking past the noise and focusing on the signal. The signal is debt. The signal is devaluation. The signal is the end of the petrodollar system. The BRICS nations are actively working on alternatives. Bilateral trade agreements are being settled in local currencies. Oil is being priced in yuan, in rupees, in rubles. The demand for dollars in global trade is slowly, inexorably declining. And when the demand for dollars declines, the value of dollars declines. And when the value of dollars declines, the price of gold in dollars rises. It is that simple. Gold is not going up. The dollar is going down. Gold is simply maintaining its purchasing power while the yardstick used to measure it shrinks. And as gold establishes this new, higher plateau, the gold-silver ratio becomes the focal point for value investors. Right now, that ratio is historically high. It takes over 80 ounces of silver to buy 1 ounce of gold. The historical average is closer to 60, and at times of monetary crisis, it has compressed to 40, 30, even 16. If the ratio simply reverts to the mean and gold stays where it is, silver would have to rise by more than 30%. If gold continues its upward trajectory, which it almost certainly will as the debt crisis deepens and the ratio compresses toward the lower end of its historical range, we are talking about silver doubling, tripling, or even quintupling from current levels. This is not hype. This is mathematics. This is the arithmetic of mean reversion combined with monetary inflation. And yet, most people will miss it. Most people will watch from the sidelines. They will see silver at $25 and think it's too expensive, remembering when it was $15. They will see it at $30 and think they missed the boat. They will see it at $40 and wait for a pullback that never comes. They will see it at $50 and finally buy, right at the top, right before the correction. This is the psychology of the herd. This is the cycle of regret. But you, the stacker, the patient accumulator, you are not the herd. You are the one buying when others are fearful, holding when others are confused, and selling only when the mania reaches a fever pitch that makes no logical sense. The game-changing nature of this moment is not just about the potential for price appreciation. It is about the shift in the monetary order itself. It is about the recognition that fiat currencies are a failed experiment, that the debt supercycle is ending, and that real assets will once again be the foundation of wealth. Silver is not just a trade. It is a conviction. It is a belief that the future will look more like the past than the present, that human nature does not change, that when trust in institutions evaporates, people turn to the one thing that has always held its value, the shiny metals that have been money since the dawn of civilization. So as we prepare to move into the final segment of this discussion, I want you to reflect on your own conviction. Why are you stacking? Is it for quick profits? Or is it for long-term preservation? The answer to that question will determine your behavior in the volatile months ahead. And behavior, in the end, is the only thing that separates the winners from the ones who get washed out. Now we arrive at the most critical part of this entire discussion, the part where we take all of this macroeconomic theory, all of this market manipulation analysis, all of this suspense about short squeezes and physical shortages, and we bring it down to the ground level. We bring it down to you, sitting there watching this video, wondering what you should actually do. Because information without action is just entertainment. Insight without implementation is just a dopamine hit for the brain. a feeling of intelligence that fades as soon as the video ends and you go back to scrolling. The game-changing nature of this moment in silver and gold is not just about knowing what is happening. It is about positioning yourself to benefit from it, to protect yourself from the downside, and to sleep soundly at night, knowing that you have taken control of your financial destiny. And that requires a framework. It requires a set of principles that guide your decisions, regardless of what the price does tomorrow or next week or next year. So let's build that framework together, right now, with clarity and conviction. First and foremost, you must understand the difference between price and value. Price is what you pay. Value is what you get. The price of silver fluctuates daily, sometimes wildly, based on paper trading, sentiment, algorithms, and headlines. The value of silver, on the other hand, is far more stable. The value is in its physical properties, its monetary history, its industrial necessity, and its role as a hedge against the incompetence of central bankers. When you view your stack through the lens of value rather than price, the daily volatility becomes noise. You stop checking the spot price every hour. You stop panicking when it drops $1. You stop getting euphoric when it rallies 50 cents. You simply hold. You accumulate when you can. You ignore the talking heads on financial television who have never held a silver coin in their lives but are happy to tell you why it's a bad investment. You develop what I call stacker's calm, the quiet confidence that comes from knowing that you own something real, something that cannot be printed into oblivion, something that has survived every empire, every currency devaluation, every financial crisis in human history. This calm is your greatest asset. It is what allows you to think clearly when others are panicking. It is what allows you to buy when others are selling. It is what allows you to hold when others are capitulating. And in the months and years ahead, that calm will be tested. The volatility in silver could become extreme. We could see moves of 10, 20, 30% in a matter of days. The commercials will try to shake you out. They will drive the price down on thin volume, trigger stop losses, create panic selling. They will use every trick in the book to separate you from your metal. And if you are focused on price, if you are leveraged, if you are impatient, they will succeed. But if you are focused on value, if you own your metal outright, if you have no debt, if you have time on your side, they cannot touch you. You are immune to their games. You are playing a different game altogether. Second, you need a strategy for accumulation. The idea is not to time the absolute bottom. Nobody can do that consistently. The idea is to average in over time, to buy on weakness, to add to your stack when the price is depressed relative to its historical value. This is called dollar cost averaging, and it is the most effective way for individual investors to build a position in a volatile asset. Set a budget. Decide how much you can comfortably allocate to silver and gold each month without affecting your lifestyle, without going into debt, without creating stress. Then, stick to that plan. If the price drops, you buy more ounces for the same dollars. If the price rises, you buy fewer ounces, but you are still accumulating. Over time, this smooths out the volatility and ensures that you are building wealth regardless of the short-term price action. And when you buy physical. Buy coins and bars that you can hold in your hand, that you can store outside the banking system, that have no counterparty risk. Avoid paper alternatives like ETFs, futures, or mining stocks if your primary goal is monetary insurance. Those paper instruments carry counterparty risk. They can be confiscated, frozen, or rendered worthless by a banking crisis or a government decree. Physical metal in your possession is the only form of ownership that is absolute. It is the only form that cannot be taken from you without your consent. And in a world where digital assets can be hacked, where bank accounts can be frozen, where governments are increasingly hostile to financial privacy, physical metal is the ultimate sanctuary. Third, and this is where the suspense reaches its peak, you must prepare for the possibility of a complete disconnect between the paper price and the physical market. This is not a theoretical scenario. It has happened before. In 2020, during the initial COVID lockdowns, the COMEX futures market for silver collapsed while physical premiums soared. You could not buy a silver eagle at any price for a period of time. The paper market was signaling one thing, but the physical market was signaling something entirely different. That was a preview. That was a warning shot. The next time, the disconnect could be permanent. The paper price could become irrelevant. The COMEX could default on delivery obligations. The exchanges could halt trading. The regulators could impose position limits or ban certain types of speculation. In that environment, the only price that matters is the price at which physical metal changes hands between individuals. And that price could be dramatically higher than the last quoted paper price. This is the nightmare scenario for the banks and the hedge funds, but it is the dream scenario for the stacker. It is the moment when the manipulation ends and the free market finally asserts itself. It is the moment when those who hold the real asset are in the driver's seat. Are you prepared for that moment? Do you have enough physical metal to meet your needs? Do you have a network of trusted individuals to trade with if the system goes down? Do you have other assets like food, water, medicine, and ammunition to complement your stack? These are uncomfortable questions, but they are necessary questions, because the game-changing nature of this era is not just about making money. It is about survival. It is about ensuring that you and your family are protected no matter what happens. Finally, and most importantly, you must cultivate a mindset of gratitude and detachment. Gratitude for the opportunity to participate in this market, to learn about these things, to have the foresight to prepare when others are sleeping. Detachment from the outcome, from the need for the price to go up tomorrow, from the obsession with being right. The paradox of investing is that the more you need the money, the harder it is to make it. The more desperate you are for a price increase, the more likely you are to make mistakes, to sell too early, to buy at the top, to panic at the bottom. The goal is to reach a state where you are financially secure enough that the price of silver could go to zero and your life would still be okay. That sounds counterintuitive, but it is the foundation of true wealth. When you are not dependent on the outcome, you make better decisions. You hold longer. You buy lower. You sell higher. You sleep better. And if silver does go parabolic, if it does reach triple digits, if it does become the trade of a lifetime, you will be in a position to take profits gracefully, to rebalance into other assets, to give generously, to enjoy the fruits of your patience. But if it doesn't, if the manipulation continues for another decade, if the price stagnates while inflation eats away at the dollar, you will still be okay because you have the metal, because you have the insurance, because you have opted out of the fiat casino. You have won either way. So as we come to the end of this deep dive, I want you to sit with these ideas. I want you to feel the weight of this moment and the lightness of being prepared. The gold price news will continue to flash. The silver charts will continue to fluctuate. The headlines will scream about Fed meetings and jobs reports and inflation data. But underneath all of that noise, the tide is rising. The foundation is shifting. The game is changing. And you, the stacker, the patient accumulator, the one who took the time to watch this entire video and think deeply about these concepts, you are ahead of the curve. You are part of a small minority that sees the matrix for what it is. Do not let that knowledge go to waste. Do not let it become just another piece of information in your overloaded brain. Let it become action. Let it become conviction. Let it become the foundation of your financial freedom. The road ahead may be bumpy. There will be twists and turns, ups and downs, moments of doubt and moments of euphoria. But if you stay the course, if you hold your nerve, if you keep stacking, you will not just survive the coming storm. You will thrive in it. You will be the calm eye in the center of the hurricane. And that, my friend, is the ultimate victory. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early. This channel exists because of you, because of the community we are building together, because of the shared commitment to truth, to freedom, to financial sovereignty. Drop a comment below with the word stacker if you made it to the end, and let me know what you are holding, what you are thinking, what questions you still have. I read these comments. I engage with this community. This is not a one-way broadcast. It is a conversation, and I want to hear your voice. Until next time, stay patient, stay focused, and keep stacking. The best is yet to come.